We are live.
Broadcast is live. Yes. Hello, everyone. Can anyone hear us?
Have we connected?
Do we see a list of participants? This is new environment for both of us.
Yes, it is new. Cannot see who are joining, but we are supposed to see the comments from everybody. So please, everybody who is listening to us, leave some comment, whether you are in YouTube, Facebook, or LinkedIn. So we will be aware that we are not alone. But even if we are, we know that you will be watching us also after the streaming.
Exactly.
Yes.
So
Yes.
it is 1 minute past. I suggest we get started. As Maria said, whenever you have anything to say or a question to ask, just leave your comment if you're on LinkedIn or in the direct link. We are very excited to spend this beautiful Wednesday morning with you guys. Today, the topic of the webinar is investment analysis practice, what science knows versus what business does. And we can see that we are receiving some comments. Hi, Alina. Hi, everyone. And good to see that we are actually live. My name is Sergey. I have done my small bit of research in the field of investment analysis, and most recently, I've been delivering analytics SaaS solutions. And my co-host today is Maria, who has some quite interesting experience to share. Maria, would you like to say a few words about yourself?
Sure, Sergey. Thank you. Happy to be here. Happy to see comments from you guys. They are coming from LinkedIn. Excellent to have you on board. Yep. So I've been working with investment analysis for quite a while and happen to be in different roles and in business and in academia. And the difference is so striking that I cannot really wait to share this experience with you. Yep, and Sergey is looking at the world through different lenses of product owner in a SaaS, software as a service environment. So Sergey's complementary experience and expertise. Happy to have you on board and having this webinar with you as well.
Thank you. Let's get this started. Maria, if you could switch to the next slide and we can walk the audience through the agenda of today's webinar. We're planning to spend roughly half an hour together with you. First half webinar will be dedicated to sharing experience from the actual business practice, mostly based on Maria's industry experience on the types of methods that are commonly used for investment analysis, for different valuation models, risk analysis. And she will also be covering the discrepancies between existing business practice and the scientific approach that she got a chance to dive into when doing a PhD and research in academia. Then in the second half of the webinar, we'll spend about 10 minutes showing a demo of the tool that Maria and I and the rest of the guys on the team have been developing over the past few months. It's called simulation decomposition, and it is designed specifically to tackle the gap between science and business in terms of valuation models. And then we'll have some closing words on the future of investment analysis, and the future of investment analysis starts now. So Maria, go ahead, take over and share your experience with us.
Yep, thank you, Sergey. So the point I'll be making here is practically displayed now. Business doesn't have time, really. Everything's supposed to be efficient and smooth to enable on-time decision making. So the methods business is using are simple and fast and often lack some comprehension and often insufficient to really get proper information for decision making. While science neglects simplicity and the speed, because in science there is a luxury of time and there is a there is a luxury of resources, so one can deep dive into the comprehensive models, really investigate things, and get proper insight. But the two worlds, although try, they rarely interact in that sense. And those methodologies that either side is using, they're kind of mutually exclusive. So that's the main point. Let's look at the examples. So I'll be talking first on my experience in business. I was working in different roles around investment analysis in a big oil corporation, and they're practically the object of our talk now is an investment project. So we were analyzing them and trying to deliver the insights to investment committee whether to make decision or not. And of course we had our cash flow evaluations, and then we were running some analyzing techniques in order to make sense out of those cash flow techniques, cash flow models. So, and yes, there are different people watching us with different backgrounds. So, of course, we are talking here about investment analysis, but if you are doing, I don't know, revenue projection or risk analysis, or if you are involved in, for example, life cycle assessment of emissions, all this stuff, I believe, still would be relevant for you, because you also have, guys, some computational models, and you're supposed to understand how they behave. So here we are. The first very common technique that we used a lot and practically we're doing for every single project is a sensitivity analysis in the form of spider chart. And this is simple, fast, serves the purpose to some extent. And practically what it does, we're just simply checking the influence of every factor to the output, in this sense, in this case, profitability, and while other factors are fixed, so we're able to see how the output is influenced. In this picture, for example, we can see that the production has the major effect on profitability. If we increase production, of course, the project becomes much more profitable. And if we don't, if it drops, then we are really in a minus, and it's a big risk.
The question here, Maria, you
Sure.
are saying that looking at this picture, we are profitability of our project is in type of direct relationship with the production volume. So is it as simple as that we increase production volume and we start making more money? Basically, are you saying that this chart is enough to make the decision on how the project would go?
Excellent question, Sergey. Of course, it's not as simple as that. If one could just simply increase the production volume while keeping all the other factors fixed, then yes, it's what we would need to do according to this picture. But in practice, well, the production volume isn't certain, so we cannot really, first of all, fully steer it. But in the realm when we can, it involves after also changing the investment cost. So it would involve changing the infrastructure, the other things in the project. So in the project structure. So in order to boost the production, so it will involve changing the cost structure and everything. And everything is quite interdependent. So it's not just a straight line here and there. Yep, we have a question about the inflation here. Yes, inflation line is a bit tricky. I remember there was, in that particular case, there was something about tax calculation. So there was an offset of the inflation in here and there in the model. So, yep.
I think
But
it's also
otherwise,
worth noting that the charts we'll be using in these slides, while they are inspired by some industry examples, we're not really disclosing real numbers. So they are more for
yeah, for sure.
example
Otherwise, I
purposes.
can. Yes, I don't want to go directly to the prison after this webinar. So yes, those charts are indeed reflecting the reality that I faced, but in terms of numbers and even a little bit of structure, they of course changed. But thank you for your question. Yep. Then what's next? if we understand that this is often not sufficient for understanding our projects, what do we do? So in our company, we were doing also decision trees. So you might think of it as a kind of scenario analysis of different options that are available and different uncertain environments that we are in, how everything will develop. But this kind of stuff we were using for complex projects that are involving going abroad or developing a new type of oil field or some complexity involved. So it wasn't a common practice at all. Yes, and
Have
then
you used decision trees in any project in your experience?
yes, yes. So with our investment committee, practically, we would receive. We had a special. Actually, we had a special different department there for analyzing complex projects like that. So
Okay.
it was a totally different business process with totally different people, but they all will ultimately come to investment committee, the practically board of directors of different departments with different backgrounds that are all involved one way or another in realizing the future investment project, and they all will make decisions. So yes, for practically for all the complex projects, for example, going abroad, we would have a decision tree there.
I think you mentioned in one of our past conversations that this was a sort of top management favorite because it neatly represents visually how things may go and what the outcome would be at the leaves of these branches.
Yes, yes. This is perhaps the most intuitive approach for the top management to perceive, indeed. And if done properly, it really nicely visualizes all the major all the major choices in the project and kind of the flexibility that you can play with, for example, choosing different contractors or different I don't know, for exploration strategies, etc., depending on what is the project about.
Does it necessarily branch every time the project team faces a decision to make, or we can also model uncertainty in that way? For example, explore the two scenarios of whether price goes up or down for a certain commodity,
Yes,
just
absolutely.
technically.
Yes, it actually combines both. So here we see, if I'm not mistaken, the squares represent the decision points where we actively choose what to do,
Okay.
and uh, then there is branches that go into different ways. Those are chancifications. So what's happening? How uncertainty develop afterwards. So for example, in the lower branch, we go after discovery directly for development, and there are different chances of how much resources we will discover there. Yes, it combines both.
Okay. Okay. So sorry for flooding you with questions. I think this looks really
No,
cool. Did you use
yeah, it's
any
excellent.
special software for decision trees? Because the visualization doesn't look like it's a paint
Yep.
thing.
So there are actually tools here and there available, but we were using simply the PowerPoint to construct those. That is. Yep. Okay, then what else? What else? Once it was a very interesting experience, actually. Uh, we quite often felt a need there to go beyond the simple sensitivity analysis where you can check influence of individual factors into understanding how different factors interact. And here you can see one of our attempts to do that. So we took three different variables that we felt were the most influential and critical for the project. It was development concept, then it was capex or capital expenses, how much practically you need to put money into the project to run it, to build it. And then resources, the green ones there, this is a factor of uncertainty that how much we'll discover is out there under the ground. And so we would have all the interactions of these factors, and we would calculate our model and the profitability indicators for every single scenario there, and we would show something like that. Actually, the actual table was even bigger than that to our investment committee, and we were trying to make a point there, and maybe we did, but investment committee didn't take it as a methodology for standard reporting. It's really quite hard to perceive and to understand what's going on in here. Of course, for analysts, it might be a good exercise to understand how the model behaves and what are the options in the project, and how different flexibilities or levers are useful or not in different uncertainty realization scenarios. But for management, it doesn't really look like a tool that you might use for making decisions.
I think it would be a bit more visual, even considering that this is this type of table format. One could color the cells of the table in such a way that one color stands for high NPV, and then the other one is at the other extreme, and then this would add another angle to the overview. But I can see why these are pretty hard to read, for sure. Also, this seems to be quite limited to 2 dimensions only. So I guess a natural question comes up if you can do anything to analyze uncertainty from more than 2 factors when table is no longer an option.
Yes, it really becomes quite complicated and crowded. Of course, as we did here in the columns for development concept and the capex, you can kind of divide them, and you can do several divisions in the rows as well. But then it becomes so complicated and so difficult to trace that it just doesn't make sense. Just a mess. Yep. Okay, then from the methods that we also were using, we tried to adopt a Monte Carlo simulation. What it is, so practically here we look at the whole spectrum of the possible outcomes with all the input factors changing simultaneously, which represents quite good the reality. Rarely we have everything fixed and only one factor is changing. But the concept wasn't adopted at all. It's I don't know. It's quite complicated for the investment committee to understand what do we actually see. The numbers here are scary because, well, in here the minimum number, for example, is when every single factor goes badly, and so it's really the possible minimum of the project, and the number is really big. But in sensitivity analysis, which managers are accustomed to see, the most negative number is the one where only a single factor is at the worst position and all the others are in the base case scenario. So this is just not acceptable for the committee to see in our case.
But at the same time, this looks like the method that represents the information to the most complete extent possible, if we may put it this way.
Well, actually, it's an arguable point. I would agree with you that indeed it represents the reality better in terms of the whole span of all possible outcomes. But on the other hand, what you can say from this distribution, you can say, okay, what is the absolute minimum and maximum of the project profitability? What is approximately the shape? Where is the probability to end up with the project profitability, but there is no actionable insight whatsoever. We don't understand how individual factors contribute to this distribution. What is more important? What to try to do to make situation better? This simply doesn't answer it. But yeah,
still better than a single number, for sure.
That's true. That's true.
And I also have, I have seen your slides beforehand, so I know that this is the method that wraps up your section. And I was wondering if you could also comment on kind of how frequently you have really resorted to these methods, because I assume that now you are presenting them, you have used all of them in different occasions. If you could throw some percentage numbers there on the most common and least common ones.
Yes, sure. I can say it for our company, and then I believe that the situation is more or less the same out there because I've been in touch with other specialists as well. So sensitivity analysis, 100%. Probably some smaller companies are not using it that often, but they are not running the function of investment valuation that often at all. So, but the big companies that have valuations on a regular basis, sensitivity analysis is a must-have, either spider chart or tornado chart. Then decision trees are quite quite, I don't know, let's say 30% of the time there's a decision tree, but it's not really about frequency, it's about complexity of the project, to be honest. And then the latest two, the table and the Monte Carlo simulation, they were just failed attempts to introduce some more complexity into the process. So we haven't really used them. And Monte Carlo simulation is still quite rarely used in the whole world in the corporations.
Okay. I think we'll get back to the reasons why these more sophisticated methods are not really adopted. We do have quite a good question in the chat. I mean, I'm wondering for myself, would you say that the three metrics, the three indicators, NPV, IRR, DPP, are actually used in business, or do you only find them in academic articles? Is there anything else that business does that science is unaware of?
Good question. Yes, indeed. Yes, those indicators are common practice in business as well when it comes to capital investments, investment project valuation. And this is those actually are main three plus profitability index also is those four we were using in the company I worked like on a regular basis. So yes, it's not only academia, it's industry. It's quite common everywhere. But then there are of course different valuation methods for different tasks. Like for example, if we go about I don't know, some asset valuation, go more from real investment to financial investments. Those are different methods and different realms. But yeah.
Shall we
Okay.
move forward then?
Yes, we move forward, and there we are already dealing with science, and here I don't really want to go into detail. My only purpose is actually to make you see how complex it is sometimes, and here it's actually one of my work with my Norwegian colleagues. We were modeling an investment with partial differential equations. And when I was doing it for the first time, surely it's a nightmare, but it's worth the effort because at the end you end up, if you're able to solve the equation, then the system of equations, then you end up in a very neat formulation and you don't need any sensitivity analysis. You just see how everything interrelates. But if you don't, and it's often the case, then you end up with the same sensitivity analysis that we were showing. And then another example is the simulation model. There's a bunch of different software available that are used for different purposes, and it's quite common to have simulation models for the investments as well. And this is an investment, and also done by one of my colleagues here in LUT University. And even to read it, it needs time. So, and even to run it, there's time needed, and to make sense of it is, oh my god, one can spend months analyzing what's going on inside such a model. So
yeah, that one is my favorite. You do need to zoom in to start making sense of it.
yeah, indeed. Yes, and I've heard of many projects of industry academia collaboration on those, and including my Norwegian colleagues with differential equations. And you know what, guys? I'm asking, do they use your results? Yes, of course, they use the insights that we delivered with these models. Question number two: do they use your models? Oh, not really. No. They only outsource us to make the insights. So it's just separate projects where one can outsource the academia to make sense out of complex investment, but industry is not doing these kind of hard things by themselves at all. So this brings us to the question of the day. Is there something that both comprehensive enough to provide sufficient information for decision making and simultaneously simple and fast so can be adopted without much of a trouble by industry? And Sergey,
Yeah, I think this has been the point that Maria has been delivering throughout her section of the webinar. And I think the last point is really valid. That whenever business faces a one-off completed project with sophisticated results or results of some sophisticated analysis, they do not deny it, and they're happy to take it forward. But there is simply no time to adopt the methods that are proposed to them and employ more sophisticated techniques in their daily routine. I mean, it requires trainings, it requires new technologies, and so on. And change management can be very tough. So, as introduced in the very beginning, our team has been on a quest to develop a tool that would be plug and play in terms of its usability, and at the same time would generate the insight to the extent necessary to make a completely informed decision. So, not going to spend too much time in the demo, but let's do some investment analysis, shall we? I'll start
of
sharing my
course.
screen, and you should be able my Excel opened right now. The example we will be considering is one that has to do with the decision to open a new unit of renewable power plant. So, very hot topic these days, green energy. We have some inputs to our model. Some of them are completely external factors, such as tax rate, discount rate, how the electricity market goes in terms of its price development, things that we cannot really affect, but we need to take them as they are. While other factors represent internal metrics or parameters that we can actually influence, like the capacity of the power plant that we are going to take into use, or the variable cost that we can land when we launch the unit. And what we have here on the right-hand side is a typical discounted cash flow model. Can't reinvent the wheel here, really. And we have NPV as the crisp valuation in thousands of euros of the investment project over the 10 years horizon. You can see that this Excel file is very static in itself, and that's the starting point for most of the analyzing techniques that Maria has introduced earlier today. If I start tweaking these factors, let's say we increase the capacity of our plant, let's say we want to generate more megawatts of energy, we see that the valuation actually goes down in this case. But what if price growth is not 4 but 8%, and we see that valuation is already in the positive range? So there is clearly a need to put together something that would describe all the possible outcomes depending on how these factors play out. And I mean, this is already a simplified example. In real life, it gets much more complex, and we see a lot of input values that need to be specified and that we cannot really control. So many things that can go wrong. That's the point. Or that could go right and then steer it in the other direction. I'm leaning towards what it may sound is that we are leaning towards a technique that has to do with simulation, with Monte Carlo simulation, that generates a picture of all potential outputs of our project, depending on how things go. And that's why the name of the project, the name of the tool is Simulation Decomposition. We have wrapped the tool in an Excel add-in. I've already installed it, and I can launch it here. You can see that it can be launched on any static model. And let's quickly specify the parameters. I mean, the point of this session is not really to promote or advertise the tool itself, but to show the methodology behind it. And then we can, of course, take the former as a separate discussion. First thing we need to do to employ the method is we need to teach the system on what kind of inputs and outputs we'd like to use in the model. So I'll click Add Input here. And I will say that capacity is one of my internal factors. It lives in this cell. And I would like to simulate scenarios where it ranges between 5 and 50, because I know that these are the technical specifications that allow for that. See that the cell is highlighted. I will add another input, which is price growth, and represents most of uncertainty for us externally. And I'd say I've gone through some reports, industry reports, market research, and I think that it will range somewhere between 4 and 8% most likely. I'll click Save. To run the model, I do need an output variable, and the output here would be the NPV as valuation metrics for our model. And there we go. So we're ready to run it.
Sergey, so the setup looks like it's just a classical Monte Carlo simulation. You just specified some inputs and where's the output. What's going on now, actually?
I think you will see it in a moment. There is one key difference between traditional Monte Carlo simulation and what simulation decomposition is doing. You can see that there is a decomposition word there. And if we take a look at the output now, what the system has been doing while we were waiting is it was breaking down the range of all potential outcomes into scenarios, into ranges of input variables that make the most impact, that are most influential in terms of whether the project ends up profitable or non-profitable. You can see that as in the pictures that you showed us earlier in the slides, this is the range of all potential outcomes if we modify the uncertain parameters the way we did in the beginning. And it ranges anywhere between -9 million and +1 million. Of course, we would like to end up here on the right-hand side of the range. And you can see many colors here. The dark blue is somewhere in the high negative numbers, something that we'd like to avoid. And then pink and overall these warm colors, red, shades of red are in the more favorable range of the distribution, with the pink one actually indicating a fully profitable project. So there is no way that with the pink side of the distribution, the project would end up unprofitable. And then here on the right-hand side in the decomposition table, we actually have a description of what these different colors mean. So the scenarios we would like to avoid all indicate high capacity of the production unit. And then regardless of how price develops, with high production capacity, we expose ourselves to the volatility of the market to the extent that there is literally no way we could make this project profitable. So we need to give up on the idea of high production capacity once and for all. And then if we take a look at low production capacity, which is something that we can specify because that's our power plant that we're opening up, then inside that scenario, there is still some volatility, and actually it's quantified. 33% of volatility comes from price growth as a parameter. So we cannot guarantee that the project would be a success, but we do minimize the risk of lending in the negative valuation range. And there is a good chance with positive average NPV that the production plant will actually be a success commercially.
Yes, Sergey. So it looks like what we achieve here is that first we have the same distribution as for Monte Carlo simulation. So we are able to see the entire picture of all possibilities. Then we can see the scenarios formed of individual factors. So we can practically understand the insight of scenario analysis that I showed at the beginning. And plus, you just explain how to read this. So in order to derive actionable insight in here, don't build a build small power plant, and then it would be a better strategy. So we are also kind of prompting a decision tree here, or kind of actionable, the roadmap of how to execute the investment, right?
Yeah, I think that's a perfect summary. And I think that's one thing that flips the perception in the eyes of top management. If we think of Monte Carlo distribution, a resulting distribution of Monte Carlo simulation, you did say that the management does not like the width of all potential outcomes, and they don't like to see the poor numbers that may end up. However, if we take a look at this picture, now it's the opposite. We can show the amount of uncertainty as one extreme, but then we can at the same time demonstrate that there are specific actions that the team can take to steer the project in the direction to limit our exposure and to end up in a range that looks way more favorable for the business, like the red part here. So at the contrast, that's a very powerful demonstration tool.
Yes, Sergey, and to clarify for our listeners, so who decides on the input variables for decomposition and on the scenarios?
Right. So as you saw, what needs to be done by the user is that we need to specify clearly the inputs for the model. So the model needs to know what the whole range of input values is. That's where the user input ends. And then the system picks up the math behind it and calculates this significance factors. So it calculates how much each one of the input factors uh, influences the variability of the output. And then based on these numbers, it decides on the ranges of different states and resulting breakdown into scenarios. So put it simply, when we look at this picture, we have a certain feeling of guarantee that this is the best split that we could think of in terms of scenarios, because it, as in a sort of clustering problem, it maximizes readability of the model so that some colors are in one range and then other colors depict a completely different type of output.
Yep. So we can say that actionable insight here is delivered automatically. And no matter what model is, SimDec will check the behavior of this particular model and get the insight where the behavior of this particular model is reflected.
Well, I will challenge that wording. I really hate when people say that some systems make the decision or create actionable insight entirely automatically, because the decision is still on a human being to make, especially when it comes to complex investment projects like this. But it is a powerful decision support system, and it does provide a chance for the user to make an informed decision for themselves. And just to close, as a closing word for this demo session, this is not only the imagination of the SimDec core team. This method was actually tested in academia and in collaboration with industry, I think in the sector of sustainability and renewable energy specifically. So this very model is inspired by one of the real cases where this was found to be pretty useful. So for the people out there, whether you are from business or from academia, if you're interested in trying it out, there are ways to do it.
Yes, and we have very interesting question. Whether it's
Okay.
possible to identify inputs in the model that managers do not want to change, but they are very important for decision making. That's excellent question. It's actually why we are doing it. Every time I run SimDec for a new model, I first include all the inputs to see what's going on inside. And then if it appears that something unintuitive going on and there is some input that I generally not pay attention to is actually firing up in here, then that's a game changer, and maybe something can be done. It can be some I don't know, some market parameter, for example. And if well, the generic perception is that we cannot control the market. It's true, but then there are multiple instruments like insurance and hedging. So if we can use them as well.
And again, this draws a line between decision support and decision making system. In that sense, if certain factors cannot be changed, like in this example, it's price dynamics, we cannot really change or decide whether price will grow fast or slowly, but it is extremely valuable to see how it affects the variability of outcomes for our model. And then we can make decisions based on the insight that it generates.
Yep, good point. Uh, Guys, our listeners, we would be happy to hear your opinion about SimDec, your questions about SimDec. I personally would love to hear what kind of experiences you have with different analyzing techniques at your jobs. And yes, go ahead, comment, and it's also okay to comment after the streaming. We'll be anyway there, and we might have a nice conversation.
I guess after we leave the webinar room, there is a website and the email address where you can reach out with any type of questions, really. So whether you're again from business or academia, we'll be happy to have a conversation about it. And just to mention one other thing and what we can do here and now together with you to transform and revolutionize the world of investment analysis. Now, now I sound very salesish, but we are on this research to business project throughout 2022. There is a core team of us, Maria and myself, being part of it, and a few other people who are also present here as listeners. We have seen how the model behaves, how the current state of the model behaves in action based on the example of this renewable power plant. It is our goal to identify best use cases possible for this application. And we are doing pilots with industry partners. There are still a few seats available for a free pilot during this year. So if you work with valuation models in Excel, in other spreadsheet, you could flag your interest, and then it would work in such a way that together we will find a relevant business model that would be interesting to test out and to try SimDec on. Then we help you configure the solution, and you get to play around with the tool that we've just demonstrated today. So if any of this resonates, rings a bell, please reach out by email to us personally or to our SimDec email. Anything from your side, Maria?
No, I'm happy, and I actually worried a lot before the webinar. It's my first experience like that, but I think it went nice, and it's a really pleasure to see that people are watching, that you're guys active, asking questions, commenting, and I look forward to more comments. So let's chat. It's interesting experience. Thank you all.
Exactly. Thank you very much, Maria. We did go a little bit over time, but it was a pleasure to co-host with you and a pleasure to talk with our audience today. We are looking forward to hearing from you. Have a great rest of the day, and I suggest we call it a webinar. Thank you very
Yep.
much. Bye.
Thank you. Bye.